Welcome to the Financial Mentor YouTube channel. Here we will teach you how to become rich. You've probably heard of ETFs. Everyone talks about them. But what exactly are they? And why do so many investors call them the easiest way to invest? In this video, I'll explain what ETFs are, how they work, why they're safer and cheaper than picking individual stocks, and how to start investing in them today. Stick around until the end. I'll show you how a simple ETF portfolio can make you financially free over time. ETF stands for Exchange Traded Fund. Think of it as a basket that holds many different investments, like stocks, bonds, or commodities. Instead of buying one company's stock, you buy a piece of hundreds. For example, if you buy an S&P 500 ETF, you instantly own shares of 500 major US companies, Apple, Microsoft, Google, Amazon, and more, all at once. It's like getting a full buffet instead of ordering one dish. Here's how they work. Each ETF tracks an index, a list of companies that represent a part of the market. The S&P 500 ETF tracks the 500 biggest US companies. The MSCI World ETF tracks companies worldwide. A bond ETF tracks government or corporate bonds. So when you buy one ETF, your money is spread automatically across many assets. You're instantly diversified. And that's what makes ETFs one of the safest and simplest investment tools. Let's be honest, most people think they can beat the market by picking the right stocks. But statistics prove the opposite. Over 90% of professional fund managers fail to outperform the market in the long run. ETFs, on the other hand, track the market itself. And because they don't have high management fees, they often outperform most actively managed funds. So instead of guessing which stock will win, you're buying the whole race. ETFs have several key advantages. 1. Diversification. You spread your risk across hundreds of companies. 2. Low cost. Fees are often below 0.2% per year. 3. Liquidity. You can buy or sell anytime during market hours. 4. Transparency. You always know what's inside your ETF. 5. Dividends. Many ETFs pay you regular income from the stocks they hold. In short, they combine the safety of mutual funds with the flexibility of individual stocks. Not all ETFs are the same. Here are the main types. Stock ETFs, the most common. They track indexes like the S&P 500 or NASDAQ. Bond ETFs, great for stability and lower risk. Sector ETFs, focus on specific industries like tech, energy, or healthcare. Commodity ETFs, let you invest in gold, silver, or oil. Thematic ETFs, for trends like clean energy, AI, or robotics. But remember, don't overcomplicate it. Most successful investors stick to broad, low-cost index ETFs. Here's how to get started in 3 simple steps. 1. Open a brokerage account with a trusted platform in your country. 2. Pick your ETFs. A simple option, 1 global stock ETF and 1 bond ETF. 3. Automate your investment. Invest a fixed amount monthly. That's called dollar cost averaging. Over time, your ETF portfolio compounds, quietly, powerfully, and automatically. Let's make it real. Imagine you invest $300 per month in just 2 ETFs. 80% in a global stock ETF, 20% in a bond ETF. After 10 years, assuming an average return of 7%, you'd have over $52,000, even though you only invested $36,000 of your own money. That's the power of diversification and compounding working together. ETFs are the simplest, safest, and smartest way to invest in today's world. You don't need to be a stock expert, just consistent. Start small, automate your investments, and let time do the rest. If you found this video helpful, hit like, subscribe, and turn on notifications. I'm your financial mentor, helping you make your money work for you.